Welcome back to the deep dive. This is where we take that stack of really dense source material, try to cut through the jargon.
There's some sense of it all.
Exactly. And give you the clearest possible picture of what is actually happening in the markets.
And today feels particularly relevant. Yeah.
Oh, absolutely. Today, we are diving into, well, what feels like a great crypto contradiction right now. Is October really poised to deliver that expected Uptober surge?
Or is this current pretty deep market dip telling us something else? Like maybe the bull run is, I don't know, running out of steam already.
It's a classic tug of war, isn't it?
Totally. On one side, you've got all this historical data that, it breeds some pretty extreme optimism for a month like October.
Right. The history says go.
But then the recent price action, well, it tells a completely different story. Bitcoin just hit 12-day lows, around $114,270.
Ouch.
And Ether dropped sharply, too. Fell below $4,300. The market's decidedly red right now.
Which really challenges that optimistic narrative.
Big time.
Okay, so that's our mission today. We want to understand this push and pull for you.
Yep.
We're going to define this whole Uptober idea, break down the bullish arguments, the ones looking at liquidity, Fed action.
The macro stuff.
Right, the big picture stuff. And then sharply contrast them with the more cautious takes. The analysts seeing specific technical speed bumps, maybe walls of profit takers.
Yeah, the resistance points.
Exactly. This dive should give you the complete picture of the landscape.
Let's do it.
Okay, so let's start with the foundation, the source of all the euphoria, Uptober.
Right.
This term, it isn't just random cheerleading, is it? It's actually rooted in Bitcoin's incredibly strong historical track record for October.
Oh, the data is genuinely compelling. I mean, it really forms the entire psychological underpinning for the bulls here.
So what does it actually say?
Well, CoinGlass metrics, they show that October has delivered positive gains. It's been in the green in 10 out of the last 12 years. Since 2013.
10 out of 12.
Yeah, that level of reliability, I mean, it's rare for any asset, let alone something as volatile as Bitcoin.
And the last time it was seriously red in October was way back in 2018, right? A 3.8% decline then.
That's the one. But when a bull market is really roaring, the gains have been huge. Think 48% in October 2017.
48%.
And 40% just back in October 2021.
Okay, so if we saw just theoretically a comparable surge this year, mathematically, where does that put Bitcoin?
Well, run the numbers from current levels, and it could push Bitcoin up towards the $165,000 mark.
165K?
That potential figure, I think that's what keeps the Uptober mantra alive and kicking.
But like you said, here's where the current contradiction bites.
Exactly. Given this historical reliability, the fact that we are dipping pretty hard right now, it's psychologically testing for traders, Yeah,
you have to decide what you trust more.
Do you trust the pattern? Or do you trust the price action you see right now? Or are we just seeing a sort of brief shakeout before history repeats itself? Or is something different this time? It's a tough call. Okay, let's pivot then. Let's look at the primary drivers that are supporting this prediction of a massive surge. Because it isn't just history, right? People are counting on external factors, macro fuel.
Correct.
So, what are the major tailwinds the bulls, like Bitcoiner Kyle Chasse, what are they pointing to?
It really comes down to the Federal Reserve.
Yeah.
And the easing cycle. Chasse focuses heavily on the predicted increase in the odds of a Fed rate cut next month.
And those odds are high.
Extremely high right now.
Yeah.
CME futures predictions, they're sitting at a staggering 92% probability for a cut.
92%. Wow, that sounds almost like a done deal.
Almost.
But doesn't relying so much on those futures predictions kind of introduce a bit of market groupthink? I mean, what if the Fed surprises everyone, holds steady because inflation is stickier than expected? How badly does the whole Uptober idea crumble then?
Well, that is the critical uncertainty, no doubt. But Chasse's perspective seems to be that the easing cycle is basically priced in, almost regardless of tiny adjustments month to month.
And this expected policy shift, it's crucial because it affects liquidity. And this brings us to that metaphor we wanted to use.
Ah, right. The fuel metaphor.
Exactly. You can think of liquidity as the fuel Bitcoin and crypto thrive on. It's what powers the engine.
So when the Fed eases policy,
they essentially inject more of that fuel into the financial system. And that, theoretically, powers a rally in risk assets like crypto.
Or fuel for the rocket. Okay, that makes sense. So if the macro picture suggests this bullish easing cycle is coming, going to provide the fuel, why does another analyst, psychedelic, think we need to drop first, like another couple $1,000s down Why the dip before the rip?
Yeah, Psychedelic's take is that the market needs one final shakeout. They actually peg the potential bottom at $112,500.
Specific number.
Very specific. The idea is that this final drop kind of fleshes out the weak hands. The usual bearish voices start getting louder, maybe panicking a bit, which, ironically, often signals the bottom is near. Precisely. So after hitting that number, completing this sort of psychological cleansing, they expect it to be on to new highs and the start of what they call the explosive final leg.
Okay. Adding another layer to this macro fuel argument, we have Arthur Hayes.
Yeah.
He's known for focusing on these deep systemic liquidity shifts, right?
Absolutely.
And he brings in something maybe a bit more complex, but you say it's crucial. The U.S. Treasury General Account, the TGA.
Yes, the TGA. Hayes talks about the market resuming up-only mode once something happens with this account.
Okay, break down the TGA for us simply. Government bank account.
That's the easiest way to think about it, yeah. It's the U.S. government's huge operational bank account. Now, when the Treasury needs to fill this account up, and it recently surged past $850 billion.
Wait, $850 billion?
Billion with a B, yeah.
Mm-hmm.
They fill it mostly by issuing bonds and selling them to the market.
Okay.
And that process effectively pulls cold, hard cash out of the commercial banking system and into the government's account.
Ah, okay, so it acts like a giant liquidity vacuum cleaner sucking money out of the market.
Precisely. That's a good way to put it. Hayes views this TGA surge as a temporary short-term liquidity drain on the wider market.
Gotcha.
So his belief is that up only can resume once this drain is complete. Basically, once the government stops pulling so much cash out.
Then that cash becomes available again.
Exactly. It can flow back into risk-on assets like crypto, allowing that upward trend to restart.
Okay, that connects the dots. But here's where, for me, the discussion gets really insightful. Because not everyone's buying the historical patterns or the impending Fed action.
Right, the cautious case.
Yeah. Why are some analysts pumping the brakes on the euphoria? Especially when, like you said, we're already seeing red right now.
Well, they're looking less at the macro and more at the internal structure of the market itself. Like analyst Augustin Fan, he's quite cautious, expecting any immediate rallies to be, quote, relatively muted.
Muted. Okay, why?
Yeah.
He points to specific technical speed bumps, right? Things acting as resistance.
Yeah, indicating internal resistance.
So what are the main technical issues we should be watching? Let's, cut through the jargon if we can.
Okay, three main things from Fan. First, he notes extremely low implied volatility and weak upside skews.
Okay, translate that. Low implied vol means?
For you, it basically means the market isn't expecting massive explosive moves in either direction. The options market, the smart money perhaps, they're pricing in a quiet, maybe grinding range, not a rocket launch.
Got it. No fireworks expected soon. What's the second thing?
Second, the momentum of DST, that's digital asset trading inflows, is weakening. Simply put, less new cash seems to be entering the market aggressively right now compared to before.
Okay, so less new buying pressure. And the third, you said was crucial.
Yeah, this one feels key. Fan points to a strong, active presence of profit takers still looking to sell to cap upside.
Profit takers. How strong is this resistance we're talking about? Is it like small retail guys selling a bit, or is it a bigger wall of supply waiting?
It sounds more like the latter. These are likely investors who bought much lower, maybe earlier in the year or even last cycle.
And now they're seeing prices they like.
Exactly. They're using every push higher as an opportunity to lock in those gains. And this constant selling pressure, it acts like a ceiling or a cap, preventing a real breakout.
Makes sense.
So, as Fan notes, this internal market friction, it means longer-term investors might just need to be more patient before we expect new ATHs because any upward momentum is getting absorbed by this selling.
Right. Okay, so internal friction, and then layering on top of that, there's the broader macro uncertainty. Jeff May brings this up.
He does. May believes the whole Uptober trend is less likely to occur this year, specifically because of that macro uncertainty.
And didn't he also mention something about September?
Yeah, interestingly, he points out that September didn't see the big fall many expected. That kind of disrupts the typical seasonal rhythm people look for leading into October.
Ah, okay. So the usual pattern is already a bit off this year.
Exactly. And this brings us to that analogy we wanted to use to explain the historical pattern maybe not holding this time.
Right, the flower analogy.
Yeah. So expecting October, just because it happened 10 out of 12 times before, it's a bit like expecting a specific type of flower to bloom exactly on October 1st, every single year, no matter what.
But the weather can change.
Precisely. And the current sort of unusual macro weather conditions like that strong TGA drain we talked about, the very active profit-taking resistance. Fan highlighted they suggest maybe the conditions aren't right for the bloom just yet. We might need to wait longer.
So the reliable historical pattern might be disrupted by these unique circumstances this year. That makes sense. But May does give a condition for the surge resuming, doesn't he?
He does. It comes back to the Fed. The trend could change, he says, if the Fed indicates more aggressive measures to stimulate the economy.
So it still hinges on policy. The focus remains squarely on that policy lever being pulled, and maybe pulled forcefully enough to overcome all this existing market inertia and resistance.
That seems to be the consensus, even among the cautious voices. It needs a catalyst.
Okay, so let's try and synthesize this. What does this all mean for you, the listener, trying to navigate the next few weeks? It sounds like a real mix.
It is.
We have that historical optimism, pretty strong external macro indicators pointing towards easing soon, rate cuts looking likely, the TGA fill maybe nearing completion,
Yeah.
but also significant active internal resistance. Profit takers are definitely selling. Technicals like low volatility aren't screaming breakout imminent.
Yeah, the real insight here, I think, is the potential for a timing mismatch.
Explain that.
Well, the market is clearly seeing selling pressure right now. That $80 billion drop in total crypto market cap recently proves sellers are active and having an impact.
Okay.
The bullish argument, though, relies heavily on specific macro policy changes, Fed easing, TGA drain ending, that are just on the horizon but not here yet.
Right. They're expected, but haven't actually happened.
Exactly. So the real risk is, what if the Fed acts too slowly? Or the TGA drain finishes later than expected? That macro fuel might arrive after the historic Uptober window has closed.
Pushing any potential surge into November, or even later.
Could be. And that gives those profit takers even more time to exert that selling pressure and potentially cap the upside.
Okay, so this leaves us with a pretty crucial question to consider as you watch the price action develop, doesn't it?
I think so.
If this internal resistance from profit takers and the low volatility environment is as strong as analysts like Fan suggest, will the Fed's eventual fuel injection just lead to a temporary bounce, one that those profit takers immediately sell into?
Or will it be powerful enough to actually overcome that inertia and ignite the true, sustained, explosive final leg of the bull run everyone's hoping for?
The strategic timing, that interplay between the macro fuel arriving and the internal resistance, that feels like the critical trade-off to watch in the coming weeks.
Absolutely. When does the fuel arrive, and is it strong enough when it does?
That's a really powerful thought to leave you with as you follow the market. Thank you for joining us for this deep dive into the whole Uptober debate.
Always a pleasure trying to map out the complexities.
Yeah, definitely complex this time. So, hey, if you found this conversation helpful, maybe you learned something, we'd love it if you'd follow, like, and share this deep dive.
Helps get the word out.
It does. And you can also follow What Bitcoin Taught Me pretty much everywhere. Twitter X, Nostr, Blue Sky, Threads, Instagram, Facebook, LinkedIn. We're out there sharing insights.
Keep learning.
Exactly. Until next time, keep learning.